All right, welcome back. This is Invest Info episode 41. All right, and this topic is going to be entitled Buying the Dip. Now, this is a term in stock investing that you're going to commonly come across, buying the dip. And when you ask most people what this means, all right, they'll tell you when the price goes down or it gets cut in half, that means I'm buying the dip price from what it was before. I'm here to tell you that just because the price went down doesn't necessarily mean you're buying the dip. Everything we do in life, we have to understand why we do it. The greater the understanding, the better. And there's a proverb that says, in the Bible, with all thy gettings, you should get understanding, right? So we have to understand the things that we say and the things that we do. Buying the dip is buying at a price cheaper from the discounted future cash flow of an asset. Now, you don't truly understand something until you can explain it, till you can teach it. And that's what I want to grow as not just an investor, but also an investing teacher, to convey information to the person very simply. So what I have before you is a house, right? A picture of a house. Now let's say this house today is worth $100,000, right? You go on a website, you see this house, it's $100,000, and based on interest rates and different factors, your financial advisor says this house is projected to be worth $400,000 10 years from now. So you say, okay, well, $400,000 discounted back today, I'm paying $100,000 for it. Sure, I'll do it. I'll buy it. That's a good deal for me, right? Now let's say in the future, again, same house, okay, it's gonna be worth $400,000 in the future. Let's say somebody's trying to sell it to you for $1 million, right? You wouldn't buy that because you say, wait a minute, I'm paying $1 million for it today, but in the future, 10 years from now, it's going to be worth 400,000. I wouldn't do that, right? Now, the next day, he's offering you $2 million. You say, look, I'm still not going to pay that. That's way overpriced. This thing is going to be worth 400,000 in the future. Why would I pay that? That's too high. And on the third day, he says, you know what? To hell with it. I'm going to sell it to you for 800,000, right? It dipped from 2 million down to 800,000. That's a drastic dip in price from over what? That's over like 50% dip in price. Then there's 60% dip in price, right? Now let me ask you, if you pay 800,000 because it went from 2 million to 800,000, right? It dipped in price. Are you still paying cheaper for the house than what it's going to be worth 10 years in the future? And that's the point that I'm trying to convey. Even though it went from 1 million, the guy's offering you 1 million, even though you know it's worth 400,000, to 2 million, double the price, you're still not going to do that. But if he says, you know what, I'm going to drop it down to 800,000 just because I like you. It's a ripoff because you're paying $800,000, double the price of something that's going to be worth $400,000 10 years from now. And the same thing happens in stock investing. That's the problem. See, somebody might give you the guise of this thing is going to grow this much in the future, and so it's worth it. Let me ask you, going back to the same house, right? It's worth $100,000. It's going to be worth $400,000 in the future. What if for some scenario, people start paying more for it, right? Somebody starts paying $1 million for this house, $2 million for this house, $3 million for this house, $4 million for this house, $5 million. At one point, do you say how much I'm going to overpay for this house if it's only going to be worth 400,000 in the future? So when we buy the dip, now let's go back to the same analogy. When we buy the dip, we're buying something that dips at a discounted price from its future cash flow. If this house is worth 100,000, it's going to be worth 400,000 in the future. A dip for us would be anything below that 100K price, which is already a beautiful price. Technically speaking, even if it's sold for 200,000, you're still going to double your money in 10 years, right? So that's the point of value investing, which all true investment should be a value investment. You're buying something for a cheaper price now in the hopes that you could sell it for more in the future. And there's ways to do that. There's fundamentals and financials to increase the probability of it likely happening. Because at the end of the day, anything is possible. You could do all the right fundamentals and, things happen where you're wrong. But it is a gamble. It is a gamble, but we want, as value investors, right? We want to increase the likelihood or the probability that we're making a sure bet. So going back to the dip analogy, if this house again was offered for 100,000, and you know it's going to be worth 400,000, and they cut the price to 50,000, that's the dip. That's a dip right there, because that's a dip in price relative to its future discounted price. Okay. So if it dips 50, and then let's say it dips down to another 30, 10, 20, 10, the more it dips, the happier you are, because you know the value of what this house will be worth in the future. And that's the sort of the crux of the issue with the retail investor like you and I. The people that's been doing this for years and years, they understand these things. But most retailers don't understand these things. We just operate off, for the most part, price. Whatever the price is, if the price goes up, I'm buying it. Even if it drops down, but it's still going to be this, and if I'm going to buy it, but not understanding the fundamentals of how to calculate the likely probability of what's going to be worth in the future. You know, at some point, you're paying too much for something that's going to be worth more in the future. You got to treat a business like this, right? When you approach a stock investment, you got to pretend you're a bank, right? Let's say you're a bank, okay? When you look around you, when somebody goes to take out a loan, what does a bank ask for? Your credit history. They want to see how well you manage debt, how good were you with your assets, the entire history. Banks don't just give people money for no reason. They want to make sure you have a proper credit history. The better your history, the better the loan, the more they could give you, because there's a greater likelihood that you could pay that money back and they'll make their profit on the interest. That's what you're doing when you're buying a piece of a company. You're lending money to this company, and they're supposed to give you back interest on the money that you loaned them. Now, just like a bank would go through a person's credit history and make sure this is a solid person to lend money to, you have to do the same thing with these businesses. And there's certain businesses out there that's not making any money, year in, year out, not making any money, and in fact, putting on more debt on themselves, but people are still lending them money. Any human being that is increasing his debt, spending more, making less money, eventually go bankrupt. This is the same thing that happened to companies. So I want you guys, if you're watching this, to start having that mindset approach, not looking at price necessarily as your sole reason to buy a company, but look at its financial. You have to do a bank the same way a bank would do a due diligence based on, you know, they'll go through your history. Some do a soft inquiry, but the greater the loan, they'll do a harder inquiry. So you have to be that bank. And depending on the size of the money you're going to put in, you have to increase the inquiry, a harder inquiry. If you want to put in 1,000 to 10,000 to 100,000, a million, you have to the deeper you have to look and check out this company to make sure that, look, in the future I'll get a return back on my investment. Don't just blindly throw money at overpriced companies just because it went 50% down. So in closing, we have to understand what we're doing, and most importantly, we have to grow as investors. Right? We have to not just keep doing the same thing over and over, and then when we sort of get screwed, be like, you know, we blame, oh, the stock market is rigged, and this is rigged, it's rigged against. No, you have to, if you do your due diligence, and value understand the value of what you have, then you will have a greater certainty when the price truly dips. Should I be buying? Should I stay? And when stock price does dip, do your investigation. Did the story change? Did the fundamentals change? Did the reason why I bought this change? If it didn't, don't worry about the stock price. You buy more. So, yeah, hope that was helpful, and I'll see you guys on the next one.